In this video, let's take a look at the federal income tax forms that have to be used to report property dispositions that we're learning about here in Chapter 3. We know that for 2018, there's a new format, the so-called postcard format for the 1040. And on this first page, there's no dollar amounts being reported. The dollar amounts are on the back side. And in lines 1 through 5, you can see the common types of income. And what we're learning in Chapter 3 is not common. So we have to first report it on a schedule number 1. And then write the total dollar amount here in line 6 and combine it with those common types of income. So let's take a look at schedule number 1. This is a new schedule created for 2018. And we're familiar with, back in Chapter 1, a Schedule C, the sole proprietorship net income or net loss. But now here in Chapter 3, we're learning about capital gains and losses that are reported on Schedule D, or ordinary income, business income, business losses, here reported on Form 4797. So these items are totaled, subtotaled, and then carried over back to that 1040 form, line number 6. Let's take a look at a Schedule D. So this is page 1, and it's divided up into two parts. The first part is short term, where the asset being disposed of was held for 1 year or less. And part 2 is long term, where the asset was held for more than a year. Keep in mind, if you held an asset for 1 year, that's short term. So typically when they say more than a year, they say a year plus a day. So, and also keep in mind, in the year that you buy a asset, it's really held by the seller. Your ownership as the buyer begins on the next day. And when you sell the asset, you own the asset on the date of sale. And the buyer for your property will now own it in the next day. So typically, if you look at a calendar year, here let's say it's a calendar year, January 1st and December 31st. If you buy the asset here and you sell it here, you have not held it for a whole year. So let's say you buy it here and you sell it here on January 1st of the next day. You've held it only for 1 year. That's still short term. So typically, you bought it here on December 31st of the previous year. Remember, this year doesn't count for you as the buyer. You own it on the next day. And you own it here for 1 year. And when you sell it on January 1st of the following year, now it's more than a year. Now it's long term. Notice that the short and long term, you first show the detail on another form called 8949, Form 8949, that is classified either as A, B, or C, D, E, or F. When you see A and D, the first two here of short and long term, that means whoever helped process the sale, it could be a broker, it could be an escrow company, will report to the taxpayer and the IRS both the sales price and the cost amount, the cost basis. Okay, both amounts are being reported to the IRS and the taxpayer when A or D applies. If only the sales price is reported to the IRS, then B would be used, or E would be used for long term. In other words, the taxpayer has to keep track of their own costs. that cost is not reported directly by the broker or escrow company to the IRS. And if you have situation C or F, then nothing was reported by the broker or the escrow company to the IRS. So the sales price and the cost all is coming from the records of the taxpayer, okay, and nothing directly reported by anyone else to the IRS. Um, we group the short-term gain and losses here to get a net short-term gain or loss, and we group all the long-term items over here at the bottom to get a net long-term gain or loss. Keeping in mind that some business assets can qualify the so-called net Section 1231 gain is going to be calculated on another form right here, 4797, and combined with the long-term items on this Schedule D. Okay, so now we gotta go to other forms to grab numbers here. But let's flip this form over, Schedule D, and we're going to combine this short-term and this long-term amount, be it gain or loss. And then the total is reported here in line 16. So this is the amount that will go back to that schedule number 1. Okay. Now keep in mind that capital gains can be taxed at different rates. For example, we learned that the 28% rate applies to collectible gains, and the maximum 25% applies to unrecaptured Section 1250 gains. And in the case of qualified dividends that you may have seen in a previous tax class, and the capital gain that we're learning in this class, either they can be taxed at very low rates like 0% or the moderate 15%, or I mentioned as a caption in the previous video, 20% if you're in a very high marginal tax rate. And then all of these percentages multiplying by their amount of gain is showing up not here on Schedule D, but on a worksheet here, worksheet, or this worksheet that are located in the instructions to Schedule D. Let's take a look at the form. Let's go back to the previous screen. This form here, 8949, 8949. Okay, 8949. This first page is short term, and you flip over to the back side, it's long term. It's kind of a mirror image of the first and second page. So you have detailed lines here for each transaction. Just like we learned how to calculate the gain or the loss, you have the sales price and minusing out the adjusted basis to get that gain or loss. And you have the dates here to indicate whether it's short term or long term. Again, notice the ABC for short term and DEF for long term. And again, the A and the D, if you check it off, that means here I only can use this page for short term, where the amount being reported to the IRS here and the taxpayer on Form 1099B, B for broker or an escrow company, is reporting both the sales price and the cost basis. If I check off B, only B can be reported on this page. If I have an A transaction, it has to be reported on another 8949. And remember, B, only the sales price is being reported and not the cost basis. And if I check off C, only this page can be used for C-type transactions, where this proceeds and basis are not reported on a 1099 to the taxpayer and IRS. Okay, the IRS really wants to crack down on people under or over reporting their cost basis. Yeah, so A is probably what they want to see, the amount of sales price and the amount of cost basis confirmed by a third party. Likewise for long term, if I check off D, this page can only be used where the proceeds and the cost basis are reported on a 1099 both to the IRS and the taxpayer. E, only sales price reported to IRS and taxpayer. F, no 1099 issued. Okay. And again, the totals of all of these different combinations go back to that Schedule D, just the totals, really these totals down here. Let's take a look at the next tax form called 4797, where you report the sale of business property. The previous form, 8949, generally is for maybe investments or capital assets, whereas this form 4797 is for the section 1231 assets. Remember, business assets. And every time I use this form, I gotta always focus on whether I should report something over here in part 1 or really on the backside. The backside is a more common place to report, page 2, the sale of business assets. But if you look at the first word here for part 3, it says gain on the disposition. So if you have a loss, it's not reported here. Loss transactions are reported over here in part 1. Also, if you have a accident, involuntary conversion, maybe it's going to be reported here, but we'll see another form possibly it needs to be reported. Back here on page 2, the more common page to start off with on this form, you would have columns for each of the different properties being sold. So just like our gain and loss formula, here is the eventual gain on each item. We learned about recapture, depreciation recapture. So here's one type called 1245 recapture, the more common. And less common would be for real property in excess of straight line. Although right now almost everything that's real estate is depreciated straight line, so this is not too common anymore. I really haven't had any taxpayers with this type of recapture here. So here is the ordinary income, the possible ordinary income, and you compare that with the amount of gain. And to the extent you have 1245 recapture, you're going to turn this gain into ordinary income, reporting that down over here. Looks like it's this line here. Okay, and then any extra gain you have, and it's kind of summarized way down here, is going to go to Schedule D. Let's see if I can see that. It's probably here someplace. Okay. Anyway, the maybe not Schedule D, but it's going to be reported here. Yeah, and then eventually the total here is going to be reported to Schedule D. And the ordinary amount is going to go straight to the 1040 form. Yeah, taxed at regular rates. The Schedule D possibly taxed at lower rates, that 0, 15, or 20%. Again, this is business assets being sold. The more common way to start off is here on page 2. Gains on the disposition to calculate the recapture, turning it into ordinary income. Let's take a look at some other topics mentioned at the end of chapter 3, where you have not a sale, but you're going to trade your old asset for a new one, called a like-kind exchange. The rules have changed over the years. But the general concept is that if you have a gain when selling an item and you want to replace that item with another property, you can possibly postpone paying the taxes on the gain by reducing the cost of the new asset. Okay, so here's the new costs. And what you're going to do is subtract that gain you're not going to pay taxes on from the new cost of the asset to get the, let's say, reduced costs you're going to use for the new asset. So because the cost is reduced, the depreciation on the new asset is going to be lower, less tax benefit, right? Or when you sell this new asset, because you have a lower cost, the gain is going to be artificially bigger because you postpone this gain, taxing the gain on the old asset. And all of this is calculated on this form here, 8824. Really, the calculations are done on the back side. Again, you're going to have a gain on the sale of the old asset, but to the extent you replace it, you can postpone reporting the gain. Here, postpone reporting the gain by reducing the basis of the old asset. Keep in mind that if you get extra cash out of selling the old asset and don't reinvest it, we learned in chapter 3 that's called boot, and boot is taxable. Okay, you cannot defer that. Okay, so that's like-kind exchanges. Another topic mentioned um, in chapter 3 is casualty losses. The rules have changed for 2018, where personal use property, you cannot claim losses. Now keep in mind that if you have insurance and you collect more than the adjusted base of the property, there is a gain to report. Okay, but in the case of business property, you still can deduct casualty losses. And maybe even if you have a gain, if you reinvest the proceeds within a certain time limit, again, you can defer that gain. So hopefully you don't need to use this form. Oh, here it says that if your personal use property was destroyed in a nationally declared disaster area, you then can probably claim a loss. Okay, but most times car accident, that's not a national disaster, right? Okay, usually has to be declared as by the president. Okay, let's move on to one more form. Another topic mentioned at the end of chapter 3 is installment sales. So what you're doing here is you're selling your property, but you're not collecting all the cash up front. Usually the buyer would go to the bank and borrow money and then give you the cash at the sales price. But here, you, the seller, you're the bank. The buyer is borrowing money from you, so you're not going to collect all the money up front. So you can make this so-called election by deferring the gain over the years in which you collect the money. So if you collect half the money, you have to report half the gain that year. If you collect 10% of the money, really they call it contract price during the year, that means you report 10% of the profit that year. It kind of makes sense because now you have so much cash to pay off your taxes. If you don't receive any cash, you don't have any money to pay off your taxes on that gain, right? So it goes through that calculation again of getting the gain or the loss, but then they calculate this so-called percentage. Where is that percentage? Gross profit, not gross profit percentage, but a gain percentage. And you multiply that percentage times the amount of cash you received during that year. And that's the amount of gain you have to report, be it capital gain or recaptured ordinary income. Okay, I think that's it for this chapter. If you have any questions, email me, work on your Learn Smart practice questions, your homework, and study before you take that chapter quiz.